Good morning, everyone. Welcome to this update for global stocks and commodities for the 1st of October, so into a new quarter. And certainly the quarter finished in the States on Friday night in very, very positive fashion. It was a very strong finish across a number of different indices and sectors, and there are some stocks that are doing fabulously well. So a really strong finish, and now sets us up for a run into what is typically the strongest period of the year, into Christmas. There is often some volatility, so I'm not saying it'll be just clear sailing, because clearly we've had some fairly ugly Octobers from time to time, but they've been pretty sparse in occurrence, and there's absolutely no issues on the horizon that would suggest that this is going to be a year where October is going to be nasty. So let's jump into it and have a look at what we're going to cover in this update. And inevitably, when markets push to new highs, lots and lots of people in the media come out and tell you why the market's about to crash. And I think I've probably had 4 or 5 in my inbox in the last week. Apple's going to fall by 50%, and the Dow Jones is going to fall by 5,000 points. And I just don't know what these people are trying to achieve, whether they actually honestly believe it, or they just think the bigger and scarier the headline, the more attention you'll pay to them. But they've been consistently wrong for a long period of time. So as I've been saying all through, trade what is, and don't get involved in what you think should be or might be. It's far easier to ride a trend than trying to predict when it will end. And history shows that new all-time highs are mostly a good thing. The basic psychology of traders and investors is to be afraid of new highs, in that somehow a new high is going to lead to the market suddenly turning down. But history shows that that's complete nonsense. And in fact, strength leads to more strength in a very high proportion of the time. Now, it was an amazing week of new highs, so I'm going to be looking at what's working, what's not working, and we're now set up. The economics in America is good. The sentiment indicators are not good, which is, for me, that's great. So there's a number of positives that we could expect a further increase in the indices through to the end of the year. So the American index, the S&P, was higher by 17 points on the week, but it was not where the real strength was. And markets just continue to ignore Washington and all of the craziness that's going on there, and dysfunction. They're also ignoring North Korea, which seems to have faded into the background again. And I think the most important thing for me is that this incredibly powerful breakout in the Russell 2000 small caps really says it all about the market. Now, if you think back a couple of months, the Russell weakened off quite suddenly and was clearly the lagging index. And that was perhaps a bit of a precursor to the market starting to enter into some sort of distribution mode. But that has quickly reversed, and the Russell in the last couple of weeks has actually been the most powerful gainers amongst all of the US indices. And so when you've got that happening, you are nowhere near the sort of sentiment that would lead to a market top. Some other things that I find really encouraging and even outstanding is that bullish sentiment fell further during the week. So this is bullish sentiment amongst retail investors. And despite the fact that we've formed new all-time highs all around, the S&P, the Russell, the Nasdaq, the Dow Jones, the retail investor is getting more and more fearful, and that's just outstanding. And mutual fund outflows, so again, this is the retail investor, is taking their money out of the market because they're nervous. There is no way that you're going to get a market top when that is happening. We haven't had the euphoric stage yet. And that's why I'm still so positive about the market, because it's just playing out in a way that strongly suggests we're just going to continue to move higher. Sector rotation continuing as always, and the stocks or the stock sectors in favour, energy, industrials and financials in particular. But look, even some parts of technology are doing well. There are industry groups within the overall sectors that are doing very well, thank you. So there's any amount of strength in the US market. Now the US dollar is bouncing a little bit, but my goodness, it's hardly convincing. And I have no confidence that this rebound in the US dollar has got any sort of legs at all. And a lower US dollar has profound implications for everything. Bonds, stock markets, real estate markets, and of course global economies. So that's certainly one to watch. So let's go and take a look at some charts. This is the S&P 500, and you can see we've clearly moved up in the last couple of days. Now that could be partly a little bit of positiveness because of the Trump tax plan, but I really struggle to see how that would be the case because there was no detail to it. There was no timetable to it. It was just an aspirational target. So I can't see that the market is pinning any real hopes on that side of things at the moment. I think this is just a case of the US economy is going along okay. Stock valuations aren't stretched, and markets just continue to rise in the face of less than bullish sentiment. So the S&P finished strongly, and as you can see, finished right on its highs. We're at all-time highs now, so there's no point in me sort of pointing to where the market might come back to. All the way through 2017, you can see the pullbacks have been fairly mild. Here was one in June of 2016. That only lasted 2 days, and then come forward to late October. It went down from 2150 to 2083, so it fell about 70 points, but that only took about 2 weeks. Not really a retracement here. That was just a pause. This was a 1 day down, another pause. This one here through July and August probably had as much substance as we've seen all year, but even that was only 3% down. So as I said at the start, you've just got to go with what is, and at the moment there's just signs of strength everywhere. Let's look at the Nasdaq, or we'll actually look at the QQQ, which is the ETF tracking the Nasdaq, because it gives us a much better volume signature that we can analyze. And you can see that, or you'll see compared to the Russell 2000, that we've kind of gone into a bit more of a sideways to yeah, it's still rising, but it's not rising at the same rate that it was. So we've got a bit of consolidation here, but that's quite normal. That's just part of sector rotation. Sectors get a bit overbought, the money starts rotating into other sectors, and so those sectors stagnate for a period. And that's sort of what's happening with technology at the moment. Probably what is, there's quite a few healthcare and biotechnology stocks in the Nasdaq as well, so they've been going extremely well. So that's probably what's creating this upward bias in the Nasdaq. But good volume behind the move last week, so that's really positive. Let's look at the Russell, and here was the period of weakness where we broke out. And that was when I said to you, we've got a breakout on our hands. That was the 25th of July. Now, the market immediately had other ideas and went back down to the bottom of the range. But that was as far as it went. And you can see it's been a very, very powerful rebound since then, down around $134 on that ETF. And now we're getting close to 150. And you can see during the week, particularly on Wednesday, so that did coincided with the announcement of Trump's tax plan. very big volume. So this was a move of real substance. We had a gap, a big range candle, one of the biggest range candles we've seen all year, and accompanied by a very, very substantial increase in volume. There's serious buying behind this. This isn't just some speculative players pushing the price up in the near term. So no surprise to see Thursday and Friday also strong. So that's a great sign for the market as a whole. Now let's look at the US dollar. So this is the ETF that gives us a bit more information because we get volume. This is UUP, which is the ETF covering the US dollar. And you can see we're getting a bit of a bounce, but closed well off the highs on the week. So this is a weekly chart. Closed well off the highs, and no particularly strong volume on the rebound. It's pretty modest. So there's really nothing there to get excited about or suggest that we're going to get a significant bounce in the US dollar that might take it up into this area up here. So we'll just have to wait and see how things play out with the US dollar. Aussie stocks, our dollar eased a little bit in conjunction with the US dollar going up, so we're back down to the bottom of this new range between 78 and 81. And it was a week where all commodity currencies, the Canadian, the New Zealand dollar, and the Australian dollar, were all under pressure. Iron ore price is highly variable, and I think that's what's making it so difficult for the big players to price in either the value of the Australian currency or the value of the Australian stock market, because iron ore is a key part of our economy, and as you'll see in the chart in a minute, it's just been all over the place. The ASX 200 index did nothing for the week, absolutely flat. And I just, as I've been saying for a long time, I just can't see what is going to be the catalyst for this to change. Our main index is heavily influenced, obviously, by the banks and the major miners, and I just can't see what's going to stimulate the banks to the upside. The major miners are a possibility. If we do start to get inflation move up, and we're already seeing a pretty positive outlook for copper, then that could improve things. But at the moment, I just don't know where that catalyst is going to come from. The only place to be in the Australian market is well-researched small and mid-cap stocks. There's just nowhere else to be. And if that's not how you're positioned, then you'll be finding it extremely hard going in the Australian market. So you need to couple that with clear entry and trade management strategies, because just buying any old small cap at any point in time and then just sitting back and waiting for a while is probably not going to work too well. You need to manage them actively, and you need to be astute about how you get into them. So let's take a look at the Australian market. So we'll just look at the finance index first of all. So not much happening there. And let's look at materials. The materials has come off the boil in the last 2 weeks. Second half of September, material index down by about 600 points. That's about 6%. So that's a fair move. And this is the ASX 200. Absolutely nothing happening there. And just to complete the picture, the Australian dollar. So we're in this range between 71 and 78. We then broke above that range. We've gone up as high as 81, but we're back down to the bottom now. And the near-term direction of the Australian dollar certainly does depend on what the US dollar does. So let's take a look at the iron ore price chart. So you can see it's just been amazingly variable over the last 18 months. Gone from 55 to 90, back to 55, up to nearly 80, and now we're back down at 70. So no wonder the Australian Treasury has difficulty in making forecasts about our currency and about our trade position and about our economy in general. when one of your main exports is moving around like that. Precious metals, gold was down by another $18, down to $12.80. That was partially US dollar strength, but also just partial selling down in gold. And again, we're back into the phase now where the market is starting to believe that the Fed will raise interest rates. And in a rising interest rate environment, gold is not as attractive. And so that's been part of the situation. Looking at the gold chart, as you'll see, I think there's still further to fall, but obviously the near-term direction of the US dollar is pretty important. But the other things that feed into gold are obviously the fear trade. So if things ramped up with North Korea, then that would be positive for gold. But leaving that aside, the short-term direction is determined by what's happening in the futures market. And when the futures market gets to extremes, either positive or negative, then you can expect pretty quickly to see a reversal. Now, we had something like 5 or 6 weeks in succession up in precious metals. And so we built up an excessive level of speculative longs in the futures market. And I talked about this a few weeks ago. We almost reached the same level of speculative longs as we had when the market peaked out in 2011. So the speculative longs were high, despite the fact that there were 30,000 contracts liquidated during the period, which runs from Tuesday to Tuesday. But interestingly, speculative shorts are also still high. So there's still a high level of short interest. So we've got these two conflicting things where we're high on both sides of the futures market. So that leaves me completely in no man's land as to where the price may go in the short term because of the futures market action. That is further complicated by the fact that GLD Holdings, the world's largest ETF, actually rose another 10 tons. So in a week when the gold price fell $18, the GLD Holdings went up by 10 tons. So I have no explanation for that. That's completely head scratching, and I won't even attempt to explain it. Rather than just observe what's important to us, and that is precious metal stocks. There is still no direction, or indeed no volatility in precious metal stocks. That's the other side. The fact that there's been no real volatility, even though the precious metals gold price has moved around quite a bit. So that's a real strange one for me. So let's take a look at gold. So we'll start with gold on a daily basis. So you can see we had a little bit of a blip into Monday, but then it was pretty much down all the way for the rest of the week. And I think we've still got a little bit further to go. Possibility that we might get down to this level here, perhaps around the 1260 mark, pick up some of these previous peaks, and that would get the gold price down to oversold. So that may be a target area. But let's look at GDX on a weekly chart. So this is the same chart that we've been looking for. These are all elements that we need to see to, and this is a useful exercise to do, is to make yourself some notes about what it is that you need to see to confirm a change in character or a change in direction. And you can see there's just nothing there at all. And I think I can probably take away this triangle that was forming now. Let's remove that. Or perhaps I'll leave this bottom one in here because we've still got this trend line that's being observed. But it's more now just a trading range, and a trading range of very low volatility, which is quite strange. Turning now to other commodities, copper slightly higher, just a couple of cents, again just currency. But crude oil has pushed further higher, and we'll see from the crude oil chart the significance of that in just a minute. For me, the ability of energy stocks just to blast straight through resistance means that the probability of a new uptrend is now significantly higher. It's not a guarantee, and I've been cautious, and possibly this is about short squeezing. So all the people that have been short the energy sector for a long period of time are now getting squeezed out. But look, we'll just have to see how it unfolds, and this is where your entry points into individual stocks is so important. You don't want to just jump on a breakout, because that breakout is, or that this uptrend, as we'll see in the energy sector, has been running now for some time, and in the short term could be getting a bit tired. So there is a smarter way to do this. As I said last week, worst case was a basing range. I think the probability of that happening now is less. The better case is the start of a new bull market, and I think the odds of that happening are now far greater. So for me, the green lights are blinking on this sector. So certainly a time to start looking for opportunities in crude oil. There's the spot copper chart. So not a lot of change there, but there's crude oil. So you can see the change that that has occurred in this long-term downtrend. So we've had a breakout from that downtrend. Yes, we need to get above this high here, and it probably just did that during the week. But that's what's been driving what's been going on in the oil patch. So let's just take a look at that index. This is XLE, and you can see that change of character started building here. So that was really, say, July, August, we started seeing a change of character. For the first time here at the end of July, we saw slight new highs. So there was the change of character there. The market had one last capitulation to the downside, and then from then it's been a very powerful rally, with the index going from 62 to 68.5, and there's been some good volume associated with that as well. So definitely a breakout in energy. You'd have to think that maybe a short-term pullback. If we pull back to this breakout and retested that, then that could be an area of interest to look for entry opportunities. So to wrap it up, I don't know how widely you read, but I read very widely, and there's just been so many investment gurus that have been consistently wrong for the last 4 years. I keep allowing these emails to come into my inbox, and I get hundreds of them a week, because I want to see what it is that people are saying and thinking out there, these commentators. And I continue to be overwhelmed by negative sentiment and very few positive sentiment. I get very few emails from commentators saying the market's about to break out and there's good positive opportunities. It's overwhelmingly negative. And so you've got to ask yourself, what does that cost the investors who listen to these so-called gurus because they've got some sort of track record? Just trust the signs of strength in the market, go with what is, and just switch off to these people, because they've already cost you an enormous amount of money if you've listened to them, and if you continue to listen to them, they'll cost you dearly. There are absolutely no signs that any pullback will be significant in the near future. Now, that's not to say that it won't happen, but at the moment there are no signs, and that's what we need to go with. Portfolio analyst this week, as usual, reading the tape is just so critical. Yes, fundamental analysis is important, but being able to read what's the market's likely to do by assessing the footprint of the big players is just absolutely critical. The focus this week is going to be on some Aussie sector analysis, plus a number of sectors in the States, including financials. There's my contact details for anyone that would like to communicate with me. And that's it for this week. We'll talk to you again next weekend. Cheers.